So welcome everyone. This is Ask the Analyst, and I guess you can ask me any question you want to go ahead and ask me. Let's go ahead and make sure that you're taking the time at the moment right now. If you haven't prepared any questions, go ahead and do so right now. Go ahead and write down some questions. I know there's already a question that's come up that I'm going to go ahead and address. We've got 30 minutes to go through this, so I'm going to be on the chopping block for the next 30 minutes. So any questions that you may have, whether it's regarding sports, the Forex markets, technical analysis, how I trade, how I got involved in trading, that's some questions that I know a lot of traders have questions about. Whatever the question is, go ahead and make sure that you get it posted in the chat. Now, just a reminder, I'm going to try and get through all the questions. If there's a lot of questions, I'm going to try and see if I can get through the questions, all the questions, but there may be some questions that I may miss out on, and I do apologize up front about that. We're going to try and get through all the questions that come through the live session. So with that being said, there's one question that's came up that I'm going to go ahead and address right now, and the question was, where do I place my stop loss when using the RSI to get in on trades? Now, I'm assuming that the question is regarding target trading. And so the answer to that question is we use the weekly ATR distance. So whatever the weekly ATR distance is where we're going to be placing our stop loss. Now, we have different ways based on different targets. We have daily targets, we have weekly targets, and we have got monthly targets. So we use the weekly ATR to place our stop losses based on that distance, but then we go ahead and we times it by either 3, 4, or we keep it at fixed 500 pips, depending on the target that we trade. So if we're talking about the daily targets, I normally take 3 times the weekly ATR. If I trade the weekly targets, I use 4 times the weekly ATR to place my stop loss. And if I trade the monthly targets, I use a fixed stop loss of 500 times. It's a 2,000 pip stop loss. So if you don't want to get stopped out and you want to be able to trade as many currency pairs as possible, and you want to be able to have a high strike rate, then trading the monthly time frames with a 2,000 pip stop loss will keep you in the market. The only thing that you need to make sure about, traders, is that you have good equity management in your trades. Now, it's very easy when you know you have a fixed stop loss, right? You can actually, in fact, use fixed lot sizes and not use percentages if you choose to. And that way you know exactly how far your stop's going to be, and you know exactly how much risk you're taking on each trade. So that's the answer to that question right here. Let's go ahead and see if there's any other questions. I'm going to go ahead and I've got the chat going over here. Let me see if there's any other questions. Which currency pair are you watching right now for a big move? Well, that's a tough question. I mean, come on, man, make it easy for me. Are you kidding me? Make it easy. And the reason why I'm saying that's a tough question is because there's so many pairs at the moment right now setting up for big opportunities. In fact, the pound crosses are some of them that are looking for big opportunities, but we can go ahead and dig into it and take a look. In fact, the Euro Aussie is another one that I've been looking at for a few months now, looking for about 2,700 pip opportunity. We'll dig into that a little bit more, but there's a lot of currency pairs. It's difficult to go ahead and isolate one currency pair and say that's my big mover, because there's a whole bunch of them that's actually setting up and waiting for that move. Now, as we've seen through the years, normally the summer period where we're expecting price to slow down, or at least volatility to slow down, we tend to see a lot of news coming out during the summer period, and that tends to actually push price in a direction very violently. All right, I'm using the word violently because it just has a very strong sell-off, a very strong rally. Now, we've noticed that last year, in 2019, we had trade wars that took place in the summer. We had Brexit that took place in the summer. We had the drone strikes on the oil in the Mid East, which created a lot of volatility out of the Canadian crosses. So we had a lot of this stuff happening during low liquidity seasons, all right? And when that happens is the breakouts are a lot more extreme. All right, I'm not going to use the word violent. It seems like I'm a violent person. But I'm going to say it's more extreme when we have the breakouts when prices are more consolidated. And that's what's happening right now. And you've probably noticed, if you haven't already, I'm going to get you to understand what's going on right here. But a few years ago, in fact, few years ago, the daily trading ranges were a lot wider. Now the daily trading range is a lot tighter. So we have to be a little bit more aware of the fact that when we're moving to the summer periods and the daily trade ranges are lower, if you're using any sort of strategy that's based on using an ATR as a stop loss, your stop loss is going to be pretty tight. But now when we have these big extreme moves in the market, then what's going to happen is those stop losses are going to be popped, or if you're in the right direction, you're going to have a great risk-reward ratio on those trades. So it's very important that we know exactly where the trend is, the overall trend is, and that we're prepared for any sort of extreme breakout. All right? Let's take a look right here. How do you get results when starting with a small trading account? Whew, that's a tough one. All right, so let's just put it this way. Everyone's going to start off with a small trading account. Well, in fact, you should start off with a small trading account in the beginning. And the reason why you want to start off with a small trading account in the beginning is because you're really new to the industry. You're new to trading. You're new to what's going on. But you want to get a little feel of exactly how it is to trade live. You want to be able to deal with the emotions as a live trader. You know, it's easy to make money on a demo account. All right, it's very easy because there's no emotions attached to those trades. So getting into a demo account and making money on a demo account should be easy. And also, if you're not making money on a demo account, there's a problem. All right. So these are the steps that you should be taking when going into live trading. First, number one, go through a strategy. Find a strategy that you're really comfortable with. Then play around with it on, I call it paper trading. What I mean is, go back. If you can use like the MT4 trading platform that has a strategy tester and that you've actually got clean data to be able to do the back testing on, do some back testing on the strategy. Take a look and see exactly what the strategy requires. Does it require you to be paying attention to the market direction? Do you need to have directional bias before deploying a trading system? All right? Go through all those tests so that you know exactly what this trading system offers you as a trader. All right? And once you understand it, once you understand exactly the conditions that you need to be in order to be able to use this strategy, then you want to go ahead and test it out on a demo. And the reason why I'm saying this, okay, is because not only now do you have to test the strategy out, but you also want to see if it's something that you can do. Because maybe the time zones that the strategy requires you to be around the computer, you're not going to be available. And so the strategy may be fantastic, but because you're not around the computer at the time where you need to start deploying it, either bullish or bearish, or in fact just deploy it, if you're not there and you're not consistent enough to be around the computer at that time, you may not get the true value of that strategy. And let me tell you this, traders, I believe every strategy is great, all right? As long as it has a proven track record and that you've gone through the test of times and gone ahead and tested everything that needs to be tested, every strategy is good. The only thing that makes a difference between a great strategy and a just okay strategy is how you deploy it, when you deploy it, when the timing is right. You know, every condition needs to be made available for that strategy to perform its best. So this is the deal. Once you've gone through all that tested on the demo account, now it's time to go live. So how do we go live? Start off small, all right? Because I'm going to tell you something that you may not want to hear, all right? Every great trader has at least blown their trading account at least 3 times. Yes, I don't know how to say this in Spanish. I don't know, but it's 1, 2, 3. 3 times, right? 3 times, at least 3 times, you would at least go through. Now, you don't necessarily have to blow your trading account, but you definitely have a huge drawdown because you either over-leveraged on the trade, you either went into a trade that you thought, well, let me ride this baby out, all right? Let me sit in this trade for a longer period of time just so that I can wait for the market to come back. And you've probably heard that saying a lot of times. Just ride it out, man. Just ride it out. The problem is you can ride it out, but if you've got bad equity management on the trade, you cannot ride it out. If you've gone into the trade expecting a 50 pip stop and now the market's gone 500 to 1,000 pip move, you're over leveraged now. Now you've gone and risked, let's say, 1% of the trade, and now it's gone 4 or 5 times, maybe 6 or 7 times deeper. Now you're in for what? Oh, hang on, wait a minute. It's gone 20 times. If it moves from 50 pips to 1,000 pips, that's 20 times deeper into your stop. So which means if you're risking 1%, you're now down 20%. Now think if you had 2 or 3 trades in. All right, if you had 3 trades in, you'll be 60% down in your account. That's how traders really get themselves into trouble. Now, the good thing is this. When you start off with smaller trading accounts, it's not going to affect you so much. But at least you get a good feel of what the live market consists of, right? And so you go and you start with a small account and you start building up. Now, the question that came up was, and I know this was a long story to get to the actual answer, but the question here was, how do we start off with a small trading account and how you build up a small trading account? Well, everything is calculated based on risk reward, and that's on you. So, me, I would probably take a trading account that's small, and if it was small enough and I want to be a little bit more aggressive, I would place a little bit more risk on the trading account. But if I was looking to build this account up, because this was maybe my only little nest egg that I have, that I don't want to go ahead and restart again, then I'll start with very low risk. Now, you may say, well, Big Dog, I can only trade 3 trades. Listen here, you don't have to trade any more than 1 trade. You can follow 1 currency pair, and that's what I did when I first started. I started first off the euro US dollar, and I traded only the euro US dollar all day, all night, every day. All right? And the same thing, when I moved away from the euro US dollar, I went to the pound US dollar. Then I went and ventured into the Swiss franc. So I stayed with the major currency pairs at first. And then once I got into managing money and I started handling bigger money, then I could venture out into more currency pairs because I had more equity to play with. All right? But I still kept the risks low. Now, the thing is with a small trading account, focusing on 1 currency pair means that you may not have a lot of trades if you're focusing in on a larger time frame. So you have to go ahead and focus in on a smaller time frame, find directional buyers on a larger time frame, and then go to a smaller time frame and pick your trades. Right? Pick your trades. Now, if you're going to be doing some short-term trading, you may want to go ahead and pay attention to the London trading session, because at the London trading session you have these breakouts, right? And if you're going to go ahead and find directional buyers and it's bearish, then you really want to look to only sell on that particular currency pair. And that's going to give you the highest probability. So look for a directional bias based on a larger time frame. Get into the London trading session, and then start trading the breakouts on the London trading session in the direction of the larger directional bias, right? And that's going to give you a high probability and help you build your account up very slowly, all right? And listen, you're going to have some patience, because it's not going to be an overnight thing. It's going to grow slowly. The good thing is your return on your investment may be higher than someone with a bigger and larger trading account, just because of the amount of lot sizes that you're going to be able to trade, that's going to be able to give you the higher rate of return on that trading account. All right? Now, let's go ahead and take a look at these. There's some more questions here. And there is a bunch of more questions here. So let me see here. How do you get results when starting with a small trading account? That I answered there. What is the difference between automated trading or hybrid trading? Listen here, this is a great question. Whoever asked that question, that is fantastic. I'm glad you asked that question, because to be honest with you, traders, a lot of the trading systems that we are developing here at Market Traders require you to have some sort of knowledge about technical analysis. Why is that? Well, if you take a trading system and you program a trading system based on historical data, all right, then that trading system is going to be performing well based on that data. But as we go into the new data, as we move forward into the actual live market, the conditions are changing. And so what we want to do as we build trading systems, and this is a great question, I'm glad you asked that. When we build trading systems, what we want to do is we want to make sure that this trading system works very well in the conditions that it's built for. Like, for instance, if I'm building a trend-based trading strategy, all right, or trend-based system, then I want to make sure that I want to test the system when the markets are really trendy. Because if this system's making money in a good trending environment, I know it's good. But if it's not, if I go ahead and test it on different currency pairs when the markets are really trending and it's not making money, man, who wants to trade that, right? So the important thing is this. As a manual trader, how would you approach the market? First, you go ahead and identify the directional bias. Once you've identified the directional bias, then what you're going to go ahead and do is you're going to go ahead and use your strategy you're using down on a lower time frame, and you're going to trade it based on the lower time frame, right? So what we do is we program that logic, exactly what you would be doing on the lower time frame. We program that to say, hey, when these conditions line up, go ahead and buy or sell, right? So as a hybrid trader, and that's the difference between hybrid trader and full automation. As a hybrid trader, what we want to do is we want to do our technical analysis based on the larger time frame. And traders, listen here, man, you must see I'm going to show you right now, I'm going to give you a good example of what I would do when I'm looking at a setup. In fact, we do this in the learning trading room, and that's all we focus on. We just focus on the directional bias. Once we establish directional bias, then what we're going to do is we're going to take the system that's been automated for that condition, and we're going to go in and deploy it either bullish only or bearish only. And that way we get the highest probability. In fact, let me take a look. Let me show you an example of exactly what I'm talking about right here, because I think this is a fantastic question that has just come up right here. Now, let me go ahead and move this over here. So what I'm going to do is I'm going to look for, and I'm going to go to, you know what I'm going to do? I'm going to go to some of the pound crosses that came up, because I think the pound crosses is what's really shown, and I believe it was maybe the pound can, well, here we go. Here's a great example right here. And I'm going to go ahead and open up my chart right here. I'm going to kill all of this patterns right here. So I'm going to go ahead and open up right here. Now, the first thing right here, the first thing I want to establish is my trend line. Now, the trend lines have moved a little bit, but I'm going to go ahead and kill everything on this chart right here. And I'm going to start from the beginning. As simple as trend lines. Listen, I'm not kidding with you. As simple as trend lines, all right? If we go ahead and place trend lines on this, it's going to give us everything that we need. All right, check this out. If I go to the chart right here and I pull up a trend line, a simple trend line, something like this, from the low here. In fact, hey, listen here, let's get crazy. I'm going to use my my smart trend line just to make sure I've got it on the right spot. So I'm going to take it from that low, and I'm going to shoot it across, and I'm just going to go ahead and extend it right here. Sorry. There we go. All right, check this out. Traders, when we have two touches right here, there and there, there's your two touches. That's confirming we should start buying. Here's the third touch, right? So I'm going to go ahead and mark it off right here. This is my third touch. I'm going to put it in a diamond form right here. Here's my third touch right here. There's my fourth touch. There's my fifth touch, all right? So when you see price touching this level of support right here, guess what we're going to be doing? We are going to look to buy towards the top of the channel. And I'm going to draw up a parallel line right here just so I can get a little more idea. And I'm going to grab this and I'm going to move it across here. Right, there it is there. So now you know, now you can see that there's a channel. Now, if I'm going to buy here, right, then what I want to do is I want to go ahead and use this. Look at this. You see how I connected this high and that high? And what did I get? I got price moving up to this level right here. So now you can see that at this point, I want to look to sell. At this point, I want to look to sell. And as price gets up to the top right here, and it hits my top of the channel, what I'm going to do? I'm going to sell. All right. Now, this is what's important. This is what is very important. Simple thing like trend lines. When you draw a trend line going up, when I use a hybrid trading approach to trade, what I want to do is as soon as price comes to my trend line that I did manually, I drew up the trend lines, I understand directional bias. I now establish that I'm in an up channel. When price comes to the bottom of the up channel, I am not waiting for a candlestick formation. I'm not waiting for some miracle to happen or some news report to come out to support that trend line. No, I'm going to deploy my automation right off the bat. As soon as we get to that level, I am buying. Why am I doing that? Because by the time a bullish candlestick formation forms or by the time a big fundamental takes the market up north, I'm already in on that trade. I'm already prepared, ready to go. Now remember, the automation that you're using, all right, it's got its own conditions in. So you may not get into the trade automatically. You may only get in on the trade when the signals apply on that system that you're using, which will be on the lower time frame. Check this out, all right? So if I go ahead, and we spoke about this in the learning trading room today, right? But if I go ahead and I look for this setup right here, and I take a look, hang on, just disappeared on me there. There we go. And I take a look over here. Look at this right here. If this is where price touched right here on the 12th of January 12th right here, what I'm going to do is I'm going to deploy my trading system bullish. Now you notice it's a bearish candle. I haven't got anything else but the market touching that candle. And I'm not waiting for anything other than a touch of my trend line right here. Now I'm going to look to go long. And if I go long with that, this is what's going to happen. I'm going to go down to the lower time frame. And I know that I don't have a lot of time to go through all of the stuff right here, but I'm going to go ahead and show you. I'm going to go down to my lower time frame right here. I've got a system built in on this that I'm using to trade here in the learning trading room. And I'm looking for the 12th of, let's see here, the 12th of January, right? Now, something you need to know. If I go to the 1 hour chart, right, so the daily chart, if this is the 12th of January, this is going to be the closing candle on the 13th, because this candle opens up on the 12th at 5 o'clock, but it closes on the 13th at 5 o'clock. So the next candle, which is the opening candle on the 13th, that's when I want to go ahead and trade. And guess what? Because I'm using an MT4 trading system, this means that my broker time is going to be 7 hours ahead. So that means by midnight on the 14th, that's when trading actually starts taking place. So the conditions have to line up exactly from around the 14th of January. Check this out. Okay, now I'm going to go to the 14th right here, and I'm looking for the 14th, midnight. So this is the 14th right here. So there's the 13th. This is where the candle on the daily closed out at 5 o'clock, right about here. All right, there it is. All right, there's the 5 o'clock candle on the 13th. That's when the candle opened up, the new candle, daily candle opened up. But remember, this is now a signal I'm looking for. And what I'm looking for is price to move above my red line. See the red line right here? So check this out. So here's the red line. Here's the signal right here. There it is there. So price gave me a 16. On the 16th, it told me to go ahead and buy. Now, I put my stop loss on the 4 hour time frame. And in this instance right here, I went ahead and I got in on this trade. Oh, there it is there actually. Got in on the trade, put my stop loss behind the 4 hour low. And yes, there's a good possibility, which we discussed in a little, that we got stopped out right here. In fact, we did get stopped out. Let's just face the facts, right? We got stopped out. But the deal is this. I know that I'm still going to be bullish. Why am I still bullish? Because my daily time frame is still in a bullish channel. So what I do, I wait for the next signal. All right? And my next signal is here. Here's my next signal right here, buy here. And I get in on this one right here and check this out. Price moves up. We've got a very tight stop loss right here. We use a 1-to-3 risk reward ratio. I've got maybe a 70 pip stop right here. I'm looking for about 210 pip target, right? That's giving me a risk reward ratio of 1-to-3. Check this out. Price moved up 290 pips. That is almost like a 1-to-4, almost a 1-to-4. In fact, it is 1-to-4 risk reward ratio on that trade, right? So guess what? When using a hybrid trading approach, we know that when using a hybrid trading approach, all we need to know is what our directional bias is. Then we go ahead and take an automated system, and we say we're only buying until we break below that channel. We're only going to buy. And if you do that, traders, you're now allowing automated systems to be able to trade for you automatically as long as we're still in that bullish trend. You don't have to go ahead and continue to pay attention to that chart anymore unless the market takes out the channel. And you can go ahead and set up an alert and say, hey, if the channel gets broken down, then I'm going to go ahead and stop the system, reevaluate the analysis, and then go ahead and make a decision on that. And that's how I use hybrid trading with a hybrid trading approach, which means that I'm doing manual technical biases. I'm finding my trend bias, and then I'm going to go ahead and use automation to deploy the system. And I promise you right now, all right, that you will have much higher probabilities and better success, and your trading is going to be a lot more relaxing because you don't have to be stuck behind the computer doing all the hard work, but you have to be part of the trade. You can't be a manager but not be active involved, all right? You've got to manage your account, and that's the best way to be able to do it, all right? I know it was a long question, and hopefully that answered the question. Let's go ahead and take a look right here. There's a couple more questions coming up right here. How can I trade on a big fundamental news announcement? Woo! How can I trade on a big fundamental announcement? All right, so the deal is this, and I'm going to be real with you, right? No sugarcoating on anything. I'm a straight cat. I talk to you as if this is your money, it's my money. We have to be real about what's going on. Let's just face the details of what's going on with news reports, all right? Firstly, number one, we don't really have big news reports anymore. And if we go ahead and use like Brexit, what's going to happen if you try to trade Brexit? If you try and trade a big news report like Brexit, and we've experienced it not once but a few times this last couple of years, but what happens is with news like that, brokers are trying to protect themselves, all right? So what they're doing is they're saying, forget about you, pal, I'm going to take care of myself. So what they're going to do is they're going to increase the spreads. They're going to increase the margin required to trade those pairs. Why are they doing that? Because they don't want you going in with big lot sizes. They're trying to minimize the risk of you going in with big lot sizes, picking up the trades, and they get caught up on the wrong side of the trend, and they have to be accountable for that. So what they're doing is they're preparing for the worst case scenario. So they increase the spreads, giving you a huge spread to get into the market, which means that by the time you actually get in, the run may even be done with. And you're going to require a lot of margin to trade there. And so trading news is really, really tough. And the only way you can trade news, all right, is to be able to trade it after the news. Because if you try and trade it before the news and there's a big gap in the market, guess what? Brokers aren't going to fool you at the price that you wanted it. They're going to fool you at the price that they can get, all right? They call it the next available price. And they will make a decision as to where that's at, all right? Where they can fill it will be dependent on them, and they'll fill you at the next available price. And that could be like 100 pips up if it's a huge fundamental. It could be 200 pips up. And then what about the spread? If they've got a wide spread, you could be 300 pips up if it's that much of a huge fundamental. Now, the news reports that we get out today, and I'm going to give you a little story. Back in about 2001, 2002, up until about 2004, we used to trade the news religiously. I mean, we made so much money from the news that it was not even funny anymore, right? It was a case of we used to do a little bit of arbitration, where we used to go ahead and take slow data, or at least slow price updates from brokers, right? So some brokers were very slow, they were very laggy on their price updates. And so what we used to do is used to open up trading accounts with those brokers that were very slow in updating their pricing. And we used to watch another trading broker that had actually the prices are very quick to update. And so what we do is, under those news reports, and like non-farm payroll, it was fantastic. Man, you don't know. We had such great runs. Non-farm payroll used to gap 150, 200 pips almost every Friday or the first Friday of the month. And so that was one of our biggest news reports that we used to trade. And so what we used to do is we used to watch the fast broker, and as soon as the broker that's updating their prices quick moves and the market jumps, we'd almost automatically start placing our trades on the slower broker in that direction. And so by the time price got to the top, they only started filling our orders, and then as soon as we got full and we see that the fast broker is starting to retrace a little bit, we used to get out of our trades right at the top. We can almost predict where the right at the top of the move was. And so we would make a huge amount of money, all right? But the problem is the brokers caught up on this, right? They started realizing, because remember, if they can't fill the order with the counterparty or the liquidity broker that they're trading with, if they cannot fill our orders, then they actually take the loss. And so eventually when they do their rollovers and they check and balances, and they realize that, man, this trade is making a killing right now, but we're paying the bill, they're eventually going to close down your trading account. And that's what happened. We had a good run for a couple of years, but then they started closing our account down. They started flagging us as traders. We weren't allowed to trade on pretty much most of the brokers out there, just because we were flagged as, hey, we're scalpers. They were scalping bad pricing. They called it bad pricing. It's their bad pricing, but we took advantage of it. So to take a long story and short enough, trading the news isn't as fun as it used to. All right, it's not as fun as it used to, and it's not as profitable as it used to. So you can trade the news, but you got to be a little bit more patient. The moves aren't as big anymore, and you got to be prepared to watch the actual spreads. Watch the spreads. Make sure that you check your leverage. Make sure your broker's a broker that doesn't freeze your platform, that you don't get in and you can't get out, and you got to phone your broker, and it's 15 minutes later and you're still stuck in a trade. You know, all of those headaches that I had back in 2000 and 2004, I just simply decided that news is just not for me. All right, I trade big accounts. I don't want to go ahead and have to struggle with fight with a broker based on news. So I don't really care about news anymore. In fact, in my own trading, my personal trading, I don't really pay attention to the news as much. You know, I used to be really in the news, and everything that comes up, I'm like, oh my gosh, this is coming, this is coming. Today, I'm like, forget about it. All right, forget about it. The news is important. It helps us get price to where we want to get out or get in. But it's not, to me, important how I trade the news. When the news comes out, it's just part of the trading strategy that we're using. So hopefully that answers your question right there. How do we trade big fundamental news? I think I addressed that. And then the last question I've got here is, can you talk about your favorite trading strategy? All right, good. Listen here, guys, I've already gone over 5 minutes of my time, so I'm going to take this last question. I do apologize that I've gone over. So this is the question. What is my favorite trading strategy? Target trading. Why? Because it allows me to have entry points at multiple levels, but it also allows me to be able to allow the system to do everything it needs to be. It's a full automated system, but I do use a hybrid trading approach where I make decisions to get out of trades. Where I get in is programmed. That's part of the logic. But where we get out is important based on trends, based on news, based on what's going on with the market, and what type of environment we trade in. But target trading has been one of my easiest, and anyone can trade it. Whether you got 1 month of experience, 10 years, 50 years of experience, target trading is one of the easiest strategies I've ever traded, because you don't even have to know where the market direction is. All you have to decide on at what levels are good for you to take a profit if price is going to continue to move against you, because we do have multi-level entry points in. All right, and so that is one of my favorite trading strategies. Hey guys, listen here. Thank you very much for all the questions. Great questions, by the way. I think the questions around hybrid trading and technical analysis and all that good stuff and automation is absolutely key. And I'm glad you asked the question. So with that being said, traders, I do appreciate you guys. Remember, these sessions are going to be every Thursday. We're going to do these sessions. I think Tyson is going to be next. Tyson Clayton will be next Thursday. So make sure to go ahead and tune in, get prepared, ready with your questions. And glad to have you guys here. We appreciate you because without you guys, it'll make my job really worthless. So thank you for coming around and joining me. This is FX Big Dog. I'll see you next time.